Social Security, stop leaving this box unchecked. It's costing you $400 a month. There is a single checkbox on a Social Security form that the average senior fills out once, never looks at again, and never questions. And for millions of retirees currently collecting Social Security benefits, that unchecked box, or that incorrectly checked box, is quietly reducing their monthly payment by $200, $300, or in many cases, more than $400 every single month. Not because of a rule change, not because of a new law, because of a decision they made years ago on a form they did not fully understand. A decision the Social Security Administration has no legal obligation to revisit on their behalf, and a decision that compounds into tens of thousands of dollars of lost income over the course of a retirement. The form is the W-4V. The box controls federal tax withholding from your Social Security check, and the mistake is not always the one you think. Some seniors are withholding tax they do not owe. Others are withholding at a rate set during their working years that has no relationship to their current tax liability. And a smaller but significant group is withholding nothing and accumulating a tax bill they do not see coming until April. All three groups are losing money. All three have a fix available right now that takes one form and one envelope. If this is your first time on this channel, subscribe now. Mr. David covers the Social Security rules, tax strategies, and government programs that directly affect seniors and retirees every week. Subscribe so you never miss a video that could put real money back in your monthly check. Before I go further, I need to address two groups of people who are already thinking this video does not apply to them, and both of them are wrong. The first group is the senior who has taxes withheld from their Social Security check and assumes the withholding amount is correct because the Social Security Administration set it up. That assumption is the most expensive one in this video. The SSA did not set your withholding amount. You did on a form you filled out years ago, possibly at a time when your income was completely different, when you were still working, when your tax situation bore no resemblance to what it is today. The SSA processes whatever withholding instruction you gave them and applies it indefinitely until you change it. They do not review your tax return. They do not check whether the amount you are withholding matches what you actually owe. They execute your original instruction every month, year after year, regardless of whether it still makes sense. The second group is the senior who has no withholding at all and is thinking they are already keeping their full check. That is partially correct, but no withholding does not mean no tax liability. If your combined income, your Social Security, your pension, your IRA withdrawals, your investment income pushes your provisional income above the taxable threshold, you owe tax on up to 85% of your Social Security benefit, whether you withheld anything or not. The seniors with zero withholding who owe tax are not keeping their full check. They are deferring a bill to April that arrives with interest and potentially a penalty for underpayment. Both groups have a version of this problem. Both groups have the same fix. Stay with me. So why does the Social Security Administration not flag this for you? The mechanism is straightforward. The SSA administers benefit payments. It does not administer tax compliance. Those are two separate federal agencies with two separate mandates and two separate databases that do not automatically communicate with each other. The SSA sends your check based on your benefit calculation and your withholding instruction. The IRS receives your tax return and calculates what you owed. Neither agency is responsible for telling you that the amount you withheld bears no relationship to the amount you actually owed. And here is what makes this systematically costly rather than just occasionally inconvenient. The W-4V form offers 4 withholding rate options: the 7%, 10%, 12%, or 22% of your monthly benefit. Most seniors who filled this form out chose one of the middle options, 10% or 12%, because those numbers felt reasonable at the time. Reasonable at the time is not the same as correct right now. A senior whose total income has dropped significantly since retirement, who now qualifies for the new senior bonus deduction, and whose provisional income falls below the Social Security taxation threshold, is withholding tax on a liability that no longer exists. The government is holding their money. It earns no interest. It comes back in April as a refund they treat as a windfall, when it was their money the entire time. Every month that withholding instruction goes uncorrected is another month of unnecessary transfer from your account to the federal government. The SSA is not going to tell you to stop. The IRS is not going to send you a letter saying you overpaid. The correction has to come from you, and it starts with understanding exactly what your correct withholding should be. My name is Professor Kyle Pomerleau. I have spent decades studying the tax treatment of Social Security benefits and the interaction between retirement income, federal withholding, and the annual tax filing obligations of American seniors. The situation I find most consistently painful is the senior who has been withholding 10% from their Social Security check for 15 years. A decision they made at 62 based on their income at 62, who is now 77, whose income is significantly lower, who qualifies for deductions they never claimed, and who has been sending the federal government between $150 and $400 per month for years, in excess of any actual tax liability. That money is not lost permanently. It comes back as a refund, but the refund arrives a year late, earns no interest, and was never the government's money to hold. The correction takes one form. Most seniors never make it because no one ever explains that the original instruction was not permanent. That is what this video fixes. Here is exactly what we are covering in the next 20 minutes. I'm going to walk through the Social Security tax withholding system, how the W-4V works, what each withholding rate actually means in dollar terms, and how to calculate the correct rate for your specific income situation. Then I am going to cover the provisional income formula, the calculation that determines whether any of your Social Security is taxable at all, because for a significant number of seniors watching this video, the correct withholding rate is 0. Then I'm going to show you 2 additional moves that interact directly with your Social Security tax liability, and that can reduce or eliminate it entirely through legal adjustments available right now. Everything is on irs.gov and ssa.gov. Every form number I reference you can download for free. Point 1, the W-4V. What it is, what it controls, and why your current rate is probably wrong. Step A, bust the misconception. The most widespread misconception about Social Security tax withholding is that it is calculated automatically based on your tax liability, similar to how withholding works on a paycheck during your working years. It is not. During your working years, your employer calculated your withholding based on your income and your W-4 elections and adjusted it with each paycheck. The SSA does nothing comparable. Your withholding rate is a flat percentage you chose on a form applied to every check with no automatic adjustment for changes in your income, your deductions, or your tax liability. If you chose 10% in 2008, you are still withholding 10% today unless you submitted a new W-4V. Step B, the actual rule in plain English. The W-4V is a voluntary withholding request form. The word voluntary is critical. You are not required to have any federal tax withheld from your Social Security benefit. Withholding is entirely optional and entirely within your control. The form offers 4 options: 7%, 10%, 12%, or 22% of your gross monthly benefit. You select one rate. That rate applies to every payment until you submit a new form. A senior receiving $2,200 per month in Social Security who selected 10% withholding is sending $220 per month, $2,640 per year to the federal government in advance of their tax filing. If their actual tax liability on their Social Security is $800 for the year, they are overpaying by $1,840 annually. That $1,840 comes back as a refund in April. It was never the government's money, it earned no interest, and the fix is one new W-4V, selecting a lower rate or 0. Step C, dual group delivery. For the lower income senior whose primary income is Social Security with a small pension or no other income, the provisional income calculation, which I will cover in point 2, may show that 0% of your Social Security is federally taxable. If that is your situation, any withholding at any rate is an unnecessary prepayment of a tax you do not owe. The correct W-4V election for you may be 0 withholding. The refund you have been receiving every April is your own money coming back to you 12 months late. For the comfortable retiree with Social Security plus pension income, IRA withdrawals, and investment income, some portion of your Social Security is likely taxable, potentially up to 85% of your benefit. But the rate at which you are currently withholding may not match your actual liability. If your income has declined since you set your withholding, if you have begun taking larger standard deductions, or if the new senior bonus deduction has reduced your taxable income below what it was when you chose your withholding rate, your current rate is almost certainly higher than necessary. Step D, the catch. Reducing or eliminating withholding creates an obligation to ensure your total tax payments through other means, estimated quarterly payments if necessary. Cover your actual annual liability. A senior who eliminates Social Security withholding entirely and has no other withholding source needs to verify that their total tax liability is genuinely zero before stopping withholding. If it is not zero, the correct fix is right-sizing the withholding to match the liability, not eliminating it and accumulating a bill. Step E, one action right now. Download Form W4V from irs.gov. It is a single page. Complete lines 1 through 4 with your personal information. On line 6, select the withholding rate that matches your actual estimated tax liability on your Social Security income, or select the option to stop withholding entirely if your liability is zero. Sign and mail it to your local Social Security Administration office. Processing typically takes 30 to 60 days. Your next check or the one after will reflect the updated withholding. You do not submit this form to the IRS, it goes to the SSA. Point 2. The Provisional Income Formula, calculating whether your Social Security is taxable at all. Step A, bust the misconception. A large number of seniors believe that Social Security benefits are always taxable, that the government taxes your benefit as a matter of course, and withholding is simply the mechanism for collecting what is owed. That belief is wrong. Whether any portion of your Social Security is federally taxable depends entirely on a calculation involving your other income. And for a significant percentage of seniors, the result of that calculation is zero taxable Social Security. Step B, the actual rule in plain English. The federal tax treatment of Social Security benefits is governed by a formula based on what the IRS calls provisional income. Provisional income is calculated as follows. Take your adjusted gross income from all sources other than Social Security. Add any tax-exempt interest income you received and add 50% of your total annual Social Security benefit. The result is your provisional income. If you are filing as a single taxpayer and your provisional income is below $25,000, none of your Social Security benefit is federally taxable. 0. If your provisional income falls between $25,000 and $34,000, up to 50% of your benefit may be taxable. Above $34,000, up to 85% may be taxable. For married couples filing jointly, the thresholds are $32,000 for the zero tax tier and $44,000 for the transition to the 85% tier. The new senior bonus deduction, $6,000 for single filers and $12,000 for married couples, does not directly reduce provisional income because provisional income is calculated before deductions. However, it reduces your taxable income after the provisional income calculation, which means it can reduce or eliminate the tax owed on whatever portion of your Social Security falls into the taxable tier. Step C, dual group delivery. For the lower income senior, run this calculation with your actual numbers right now. Take your pension income, any part-time earnings, any IRA withdrawal amounts, and any interest or dividend income. Add 50% of your annual Social Security benefit. If the total is below $25,000 as a single filer or $32,000 as a married couple, your Social Security withholding should be zero. If you have been withholding at 7 or 10%, you have been prepaying a tax you do not owe. For the comfortable retiree, your provisional income likely exceeds the lower threshold, meaning some portion of your Social Security is taxable, but the calculation may show that the taxable portion is smaller than your current withholding assumes. A married couple with $28,000 in pension income, $8,000 in IRA withdrawals, and $30,000 in annual Social Security has a provisional income of $51,000, placing them in the 85% tier. But after the standard deduction and the senior bonus deduction, their actual taxable income may be low enough that the effective tax rate on their Social Security income is far below their current withholding rate. Step D, the catch. The provisional income calculation uses gross income figures before deductions, which means you cannot simply look at your taxable income from last year's return and assume that number reflects your Social Security tax exposure. The provisional income threshold is lower than most retirees expect, and income sources that many seniors consider minor. A small amount of municipal bond interest, a modest part-time income, can push provisional income above the zero tax threshold. The calculation needs to be done with every income source included. Step E. One action right now. Take last year's tax return and identify your adjusted gross income excluding Social Security. Add any tax-exempt interest shown on line 2A of your Form 1040. Add 50% of the total Social Security benefits shown in Box 5 of your SSA-1099. Compare the result to the thresholds: $25,000 single, $32,000 married. If you are below the threshold, your correct Social Security withholding is 0. If you are above it, calculate the actual tax on the taxable portion and compare it to what you are currently withholding annually. The difference is the adjustment your W-4V needs to reflect. Point 3. The SSA 44, the form that reduces your Medicare premium when your income drops. Step A. Bust the misconception. Most seniors focus on the withholding coming out of their Social Security check and overlook a second deduction that reduces their net payment every month: the Medicare Part B and Part D premium. For higher income retirees, this premium includes an income-related monthly adjustment amount, known as IRMAA, which is a surcharge added to the standard premium based on income. The misconception is that this surcharge is fixed and unappealable. It is not. It is based on income from 2 years ago, and if your income has dropped since then, you are paying a surcharge based on a financial picture that no longer exists. Step B. The actual rule in plain English. Medicare uses your tax return from 2 years prior to determine your Part B and Part D premium for the current year. If you retired at 64, earned a full working salary, and enrolled in Medicare at 65, your first year of Medicare premiums will be calculated based on your income at 63, your last full year of work. Your income may have dropped by 50 or 60% at retirement, but Medicare does not know that yet because it is looking at old data. The SSA 44, Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form, allows you to request a recalculation of your Medicare premium based on your current income rather than your 2-year-old income. The qualifying life-changing events listed on the form include retirement, reduction in work hours, loss of income-producing property, loss of pension income, and the death of a spouse. Retirement is specifically listed. If you retired in the past 2 years and your income dropped at retirement, you qualify to file this form and request a premium recalculation immediately. Step C. Dual group delivery. For the lower income senior whose income did not significantly change at retirement, the IRMAA surcharge may not apply to you at all. The standard Medicare Part B premium applies to individuals with income below $103,000 and married couples below $206,000. If your income has always been below these thresholds, this point does not affect your premium. For the comfortable retiree who was earning above those thresholds during their working years, the IRMAA surcharge can add between $70 and $443 per month to your Medicare Part B premium alone on top of the standard premium based on income from 2 years prior. A retiree paying an IRMAA surcharge based on a working income they no longer earn is overpaying their Medicare premium every single month. The SSA 44 is a single form that triggers an immediate recalculation. I have seen this form put between $800 and $5,000 per year back in a retiree's pocket with one submission. Step D. The catch. The SSA 44 requires documentation of the life-changing event. For retirement, you need a letter from your former employer confirming your retirement date or your final pay stub showing the end of your employment. For a reduction in income from a business, you need documentation showing the income change. The form cannot be processed without supporting documentation, and incomplete submissions are rejected and must be resubmitted, adding months to the processing timeline. Step E. One action right now. Download Form SSA-44 from ssa.gov. Review the list of qualifying life-changing events on page 2. If you retired within the past 2 years, reduced your work hours, lost a pension, or experienced any other qualifying event that reduced your income, complete the form with your current income estimate and attach the required documentation. Submit it to your local Social Security office in person or by certified mail. Processing typically takes 30 to 90 days. The premium reduction applies prospectively from the month the form is processed. Every month you delay is a month of overpayment that cannot be recovered retroactively. Everything I just covered applies to every senior receiving Social Security regardless of income level. The W-4V fix is available to everyone. The provisional income calculation is essential for everyone. The SSA 44 applies specifically to higher income retirees whose Medicare premiums include an IRMAA surcharge. What I am about to add is for the retiree who wants to go beyond fixing their withholding and actually reduce the underlying tax liability on their Social Security. Not just match the withholding to the liability, but legally reduce the liability itself. If getting your withholding right is enough for now, the first 3 points fully covered what you need. But if you want to go further, these next 2 points address strategies that reduce the provisional income calculation directly. Bonus 1, Roth conversion window that reduces future Social Security taxation. The provisional income formula that determines Social Security taxability includes traditional IRA withdrawals in full. Every dollar you withdraw from a traditional IRA adds a dollar to your provisional income, pushing more of your Social Security into the taxable tier or deeper into the 85% tier. A retiree taking $20,000 per year from a traditional IRA is adding $20,000 to the provisional income number that determines how much of their Social Security is taxed. Roth IRA withdrawals are different. Qualified Roth IRA distributions are not included in adjusted gross income and are not included in the provisional income calculation. A retiree who converts traditional IRA funds to a Roth IRA during the low-income years immediately following retirement, before Social Security begins or before required minimum distributions begin, pays income tax on the converted amount at their current low rate and permanently removes those funds from the provisional income calculation for all future years. The practical effect is this. A retiree who converts $150,000 from a traditional IRA to a Roth over 3 years at a 12% effective rate pays $18,000 in conversion tax and permanently reduces their annual provisional income by the amount of future withdrawals from that converted balance. If those withdrawals would have been $15,000 per year, the conversion reduces provisional income by $15,000 annually going forward, potentially dropping the taxable percentage of Social Security from 85% to 50% or from 50% to zero. The tax savings on Social Security alone can recover the conversion cost within 5 to 7 years. Bonus 2, the qualified charitable distribution that reduces provisional income directly. For seniors 70 and a half or older who make charitable contributions and have funds in a traditional IRA, the qualified charitable distribution, covered in a previous video on this channel, reduces provisional income directly rather than simply providing a deduction. A standard charitable deduction reduces your taxable income after the provisional income calculation is complete. It has no effect on the provisional income number itself. A QCD, by contrast, removes the distributed amount from your gross income entirely. It never appears on your tax return as income. Because it never appears as income, it never enters the provisional income calculation. A $10,000 QCD from a traditional IRA reduces your adjusted gross income by $10,000, reduces your provisional income by $10,000, and may drop the taxable percentage of your Social Security from one tier to a lower tier or from a taxable tier to zero. For a senior in the 85% provisional income tier whose Social Security benefit is $2,000 per month, dropping the taxable percentage from 85 to 50% eliminates tax on $8,400 per year of Social Security income. At a 22% tax rate, that is $1,848 per year in tax savings from a single QCD. In addition to the charitable deduction value the donor would have lost by taking the standard deduction. Let me bring everything together with the one idea that connects every point we covered today. The Social Security Administration sends your check based on your benefit calculation and your withholding instruction. It does not review your tax return. It does not check whether your withholding matches your liability. It does not flag you when your provisional income drops below the taxation threshold. It executes your original instruction every month until you change it. The IRS receives your return, calculates what you owed, and processes your refund. But it does not contact the SSA on your behalf to suggest you adjust your withholding. And Medicare calculates your premium from 2-year-old income data and continues charging the higher amount until you file the SSA 44 to trigger a recalculation. Every one of these systems operates in its own lane. None of them is designed to optimize your outcome. They are each designed to execute their specific function: the optimization, the W4V correction, the provisional income calculation, the SSA 44 filing, the Roth conversion timing. The QCD strategy has to come from you, from knowledge of how these systems interact and deliberate decisions about how to position yourself within them. Professor Kyle Pomerlow's message for this channel is always the same. These rules exist in your favor more often than the agencies administering them will tell you. The only thing standing between you and a larger monthly check is understanding the system well enough to use it correctly. You now have that understanding. Act on it before another month passes. Before you close this, do one thing. Send this video to one person in your life who is over 65 and collecting Social Security. A parent, a sibling, a neighbor, a friend you see at church. It does not matter whether they are getting by on a fixed income or collecting a comfortable benefit alongside a pension. Every single senior who filled out a W4V at any point in the past and never updated it is almost certainly withholding the wrong amount, either too much or not enough. The person you are thinking of right now is very likely in that group. One conversation started by this video could add $200 to $400 to their monthly check starting next month. That is money they earned. That is money that belongs to them. And it is sitting in a federal withholding account earning no interest because no one ever told them the original form was not permanent. That is what this channel is here to fix. In the next video, I am going to show you the Medicare form that reverses an IRMAA surcharge going back 12 months. A form most retirees never file because they do not know retroactive relief is available, and that can recover thousands of dollars in overpaid premiums in a single submission. I will see you there.